Have you ever bought something that if you ever lost it or it broke, you'd have to buy it again? A product that had brand power, that ain't going nowhere, that you can count on for people to buy? I'm looking to own a business that sells one of these products. A piece of a business that I know I can hold. A company whose management team doesn't suck the blood out of the shareholder. A situation where the stock is disconnected from the company, where hedge funds and institutions are pushing down the stock to levels that create opportunities. But the timing has to be right. Let me explain. You know how, like, when everything's good in life, everybody wants to be around and everybody's around you maybe because you got it going on, and then you hit rock bottom, and and then suddenly nobody wants to be around. You're not cool anymore. Nobody wants to be your friend. Well, I view value differently. It's a temperament. The trick is extracting the value through character. A character that has discipline, patience, and well-timed aggression in order to fuel my quest for growth and diversify from real estate. But what could it be? Yep, it's Crocs. Hey, what's going on, YouTube? Welcome to the channel, Goofy Investing, the first ever video made. We're going to talk about why I'm buying Crocs in the position and what my intentions are, and overall my whole idea about the investment. So let's pull up some stuff here. Let's talk about valuation. All right. You see, valuation is a funny thing. And what I mean by that is each of these stocks have different shareholder bases. You have value investors, you have dividend investors, and you have growth investors, and then you just have investors like me that just want to make money. That are willing to take risks that other people are not willing to take. I'll admit I'm more growth oriented right now. But if you look here, let's look at the valuation as far as traditional accounting measures tell us. All right. So this is on Seeking Alpha. I pulled up Crocs and some different competitors. We have Skechers, we have Nike, and we have Deckers. So on traditional PE metrics and Gap metrics, where Crocs trades cheaper than all these other competitors. Now Nike is over 160 billion market cap, and Crocs is a much smaller company, which is, I'll be honest, a little more attractive to me. They traded about 6.5 billion. So Crocs really has Nike to aspire to. Now that doesn't mean that they're going to be able to command the multiples right now, and there's different reasons why we're trading cheaper here on a traditional metrics. So let's look at the growth here. All right, look at the revenue growth and all these growth numbers compared to all the competitors here. All right, they pretty much dwarf all the other companies in terms of percentage wise. Um, so let's look at margins. Once again, look at how much these margins are are much better than than all the other shoe companies. That's why I pick. That's one of many reasons why I pick Crocs, because they're a leader in this industry. I mean, it's pretty apparent. All right. So let's pull up projected growth here. All right. On a forward PE metrics, we're trading at an 8 forward PE, and analysts got this company growing a little over 7.5%, which I'm I think they're going to do 15% next year. To tell you the truth, I mean they're already this year they've already upped their guidance. We'll talk a little bit about the earnings, but if I'm if I'm going to get growth here, if in all reality I'm at a peg to of a one, then a price to earnings growth of one, and I'm getting a company that has strong free cash flows, that's a pretty attractive proposition. And one reason why, that's one of the reasons why I'm building this position, um, is this is a growth company trading like a value stock. So, I mean, I could picture it already. My family calling me up, because a bunch of real estate investors, what have you, calling me up. Are you drunk? You you bought your free cash flows are backed by shoes. we need, we need to have a family intervention. So, hold on. All right, alkaline. Okay, but yeah, so growth stock priced like a value stock. Um, and value investors, they'll look at historicals. They'll look at these financials and past metrics, and they'll say to themselves, okay, what are the predictable cash flows in the future? What's the predictable projected safe free cash flows? And yes, the dollar earned that's safer is going to be more expensive than the riskier dollar earned. Um, but there's a lot more to it. Okay, so I want to. Here's a risk that I see with Crocs is I'm going to go to this balance sheet here. Okay, and if we see here, if we see right here, their cash and cash equivalents, they added 40 million to their cash and cash equivalents. However, this is June. They reported on in July. They reported in July that let me see here, buybacks. Yep. So in July they said they bought back 50 million worth of stock. So I haven't seen. We don't see the balance sheet for July, but because they report quarterly. But you know if that's correct in dispelling or minus some other accounting measure that I haven't seen yet, this is not really accurate right now. So I'm projecting this looks like 116 million on the balance sheet for cash and cash equivalents. Now I'm not saying that they're going to go bankrupt or anything, but I mean their cash position and liquidity is going down. And I'm an investor. I'm just here for the ride. And Andrew Reese is the captain of the ship. The CEO is the captain of the ship. But if hey, I'm willing to take risk, but you're maneuvering this company like it's a fighter jet. And my shares are precious cargo. So this company gets caught up in a pinch for liquidity, and they need to refinance some notes in this high interest rate environment. That's a risk. In the event that if something like that happens, this stock is going down. All right, so I mean that's one risk to consider. I mean, now the board has approved $1 billion remaining share repurchase. I want to talk about that. Um, I mean, I don't. I would rather. I would rather the company, like one side of me says, I'd rather the company pay down the debt, and another side of me says, yes, the shares are trading cheap. So go ahead and increase shareholder value by buying back shares. I would rather delay gratification though, and see them pay off this debt, because their credit rating. Um, I mean, with their credit rating, they raised 2 billion in senior notes at a B rating. Um, and that's one reason why financial institution money is not coming into this stock. You see, I'm not really so concerned about inflows from institutions buying and pushing up the stock because I have inflows from the strong free cash flow. Now, if this was a company that didn't make money, yes, I would be way more concerned about the inflows of institutional buying. So the senior notes, they're due. I pulled this up on their 10K. Their senior notes, those 2 billion in senior notes are due in 2029. So they got time to to pay it off. But we're in 2023. I'm gonna give this a 5 year investing time horizon, tentative in condition to them paying off these notes. Because if we hit a debt maturity wall in 2029, and they still have notes outstanding, it's going to impact their free cash flows and be a hang on the stock, and that'll destroy shareholder value. So I'm cognizant of that. Okay, so let's go back with a little clarification. All right, so their 1 billion is authorized for share repurchase, but they're going to balance that between paying off the long term debt and buying back shares, depending on maybe the fluctuation of the stock price and what they'll make their assessment on that, and that's going to come from the free cash flows. My thesis is if they pay down the debt, they will increase this. They'll get an upgrade from a double B negative credit rating, from a corporate credit rating, and as the credit rating gets increased, they'll be able to command a higher multiple because financial institutions will start investing more because they'll view the stock as, or view the company as, less leveraged and safer with their free cash flows. So that's one thesis that I have, that this stock will command a higher premium later as we gradually go there. Now let's talk about my position and what I intend to do with this stock. Okay, so currently I own 115 shares. Um, Cost base is 108. Now I bought 100 shares over here, all in June, and then when the earnings hit, the street sold it off and punished the stock. It punished the management for good performance. Anyway, they sold it off for about 15%. So I increased my position 15%. So that's why I have 115 shares. Um, Depending on opportunity costs and other positions out there, and how the stock trades, I may or may not increase the position dollar cost averaging. But I will say this: if these levels continue to trade at around the low 100s, I'm probably going to keep buying. Um, where do I see this stock in 5 years? I wouldn't be surprised if they continue to grow and they continue to pay off debt and buy back shares and continue with the plan. I wouldn't be surprised to see this as a 300 a share stock in 5 years. Okay, so that was my take on Crocs and why I'm investing. Um, hey, comment down below on what you think about the video. What do you think about Crocs? And if you wanna see another video on Crocs, or you want me to dive into another position, please like and subscribe. Hit the bell notification for my next upcoming video. Thank you all, and have a good day.